everyone, welcome back to yet another episode of Reinventing Finance. As usual, I'm not all by myself. We have a great guest, but before we get to him, Tom, how are you this fine morning?
Very fine. Summer started, so...
At least for some of us, it's morning, and summer has started. I don't actually know. Alex, you are dialing in from down under, so it's probably not quite the morning for you. Thanks for making this work anyway. Alex, welcome on our podcast. Why don't you briefly introduce yourself, who you are, and what do you do?
Thanks so much, Nick. And look, we often forget in the team that I work in QBE what time of day it is. We work with people around the globe, but that's probably a good lead into who I am and what I do. So I'm Alex Taylor. I'm the Global Head of Emerging Technology in QBE Ventures inside QBE Insurance. So for those of you that don't know, QBE is a global insurer. We operate in many countries around the world, including most of Europe, most of Asia, all of America, Australia, a few other countries around the traps. My role and that of my team is to invest in the future of our industry, of the insurance industry. So we spend a lot of our day listening to teams inside insurance that essentially answer the question of, I would love to do this, but I can't because. And it's what comes after the because that we try to solve for. And more often than not, those capabilities that we find come from outside of our own organization. They come from younger organizations that dare to do something incredible that we invest in, as an investor, as a ventures team, but also deploy. We get excited about technology. I'm a technologist and decades standing. And the thing that gets me out of bed in the morning is helping younger companies to find the traction they need to do something exciting and to excite incumbent insurers to say, look, you might be underwriting a property policy this way now, but now you can see the same property from space. So this is why that would be different. But we replicate that across every sector that we work in. And, we underwrite most insurance products in the market in the end. And I confidently believe that there's something to do with nascent technology in all of the products that we sell. So that's me.
That's very interesting. So we've seen quite a few large insurance groups try different ways to bring inside and outside innovation to the fold. I was when doing a little bit of research on you, I haven't seen that many who connected it quite like you guys did. Maybe before going a little bit into what you did, QBE Ventures above and what you've said, what was the rationale behind combining venture investing towards something like internal acceleration, building technology investing? What was the rationale behind that?
It's a great question. And I like to think that collectively in our team, we've brought the benefit of experience. And certainly we've collectively made mistakes that have led to lack of traction of this type of activity in large insurers, inside large banks. And it all comes down to the way that stakeholder engagement works. It's very easy to fall into the trap of what I like to call innovation theater, pretending to do something of value when in effect all you're really doing is getting people excited, maybe exciting some shareholders to drive up that share price. The reality of what we do in QBE Ventures is to make sure that our stakeholders, our sponsors, are constantly informed, that the work that we do is visible so that when we need to make an investment, when we need to stand behind a particular technology or capability, our stakeholders know that we wouldn't put it in front of them unless it was something that was going to be dramatically innovative or disruptive, or generally something that we need to do, either because the market is or because it will drive dramatic change to the products that we sell. What that means is that more often than not, it's a delicate balance between investment or what would classically be called enterprise innovation, or a combination of the two, where we take one of these outside capabilities, we build and surround it with things that we uniquely have or we do well, which is often data or capability and product execution, and build something that's genuinely new, something that the InsurTech couldn't have done by themselves, something that we couldn't have done by ourselves, but to create something that's greater than the sum of its parts.
So what type of profiles, and how large is your team to pull something like this off? Because it's not exactly the same skill set, especially if you were some corporate VCs, maybe having listened too much to traditional VCs, kind of go with purely financial investors. That's our goal, and we have a just one limited partner. What does your team consist of, and how large are you, to kind of get a bit of a feeling of how that works?
Yeah, it's a great question, and that balance is something that we've worked very hard on to make sure that we think that the team we've constructed is unique, and we've got people from backgrounds across traditional investment and investment banking, people like myself that have traditionally come from technology careers, and I've spent 35 years building my technology skills. To some of our partnerships team in our ventures team. So Lynn Thompson, my colleague, who's the global head of partnerships in ventures, comes from a consulting background and from a data background. And she and her team are sort of the unique component to what we do, in that internal and external partnering gives us the mandate to achieve what we do. In a similar way, myself with my technology background and that of my team means that we can sit down with our architects, with our technologists. They can speak to someone that they're fundamentally familiar with talking to in a style that they're used to communicating in, and actually be open about the problems they face. And then collectively, we can take that to market and find things that solve for what they do. And what that translates to is that we genuinely hope that the teams we work with in QBE see us as their friends. We solve their problems for them by bringing something to them that they couldn't do themselves. But at the same time, we hope that QBE loves us because we generate a good return for the business as well. But it's equally important to make sure that we get that right. Purely being a financial investor, I don't think would be very attractive to our team in general, even though it might generate a solid return for QBE, and we do. The promise of what we might do to collectively bring the industry forward is also extremely important, and that's what gets us to the table. That's why we're collectively here as a team, the 13 of us that we have now, and we're not a big team, but we hope we punch above our weight and really drive not just our company forward, but the industry as well.
But let's say to put it in a very practical way, let's say what was the most successful thing you did, and what was, let's say, the learning which you would say, okay, we wouldn't do this again?
Yeah, great question, and a challenging one to answer as well. So look, I'm really proud of our geospatial work at the moment. So we've made 2 recent investments in the geospatial space, TensorFlight and Geosight, and another one that's a little bit older called Jupiter Intelligence. But I think it's very clear that collectively the insurance industry needs a lot of maturing in the property space. We have some very successful products, as do our competitors in property, but the value of more recent data sources, things like satellite imagery, SAR radar platforms, predictive systems that look at the impact of the IPCC climate models, these things didn't exist a decade ago. The fact that they do now is giving us the opportunity to dramatically transform our data systems, to have open and honest discussions with our customers about their exposure, and in some cases mitigate events that might now not occur, or the impact of which might not be as profound, because we've worked with the customers ahead of time. There's a classic example that I like to share at the moment from Hurricane Ian in the United States. So people will remember that from September, October last year. We did a rooftop analysis of buildings in Florida, looking at the types of roofs that were more commonly damaged as a result of substantial wind loading. And bitumen tiles were dramatically more damaged than traditional tin roofs. And that was an interesting insight because, of course, those that know the United States market know that bitumen roofs are quite common, but the price model, the cost of a bitumen roof and a tin roof are about equal. But if you're in a hurricane zone, making one decision or the other will lead to dramatically different insurance outcomes. So now that we're armed with that kind of information, we can start to work with our customers that, when they're replacing their roofs, even if we see a roof that's damaged, we can start to use our systems to share our insights with them to create a more resilient portfolio and, frankly, a more resilient world. On the other side of the fence, things that haven't gone particularly well. And look, I'm not going to name names on investments, but the thing that always offers a challenge to insurance investment is traction. Finding something that uniquely makes a particular organization able to succeed in the market. Otherwise, you're just lost in the noise. And more often than not, the things that tend not to go well are things that we don't validate we would use for ourselves. The classic phrase is eating your own dog food. And if it's a capability that we wouldn't use, why would we expect the market to use it either? That's why we're so keen on making sure that we're customer number one, because in the end, if we find value, it's likely that others will as well. And I like to think that with all of the recent investments we've made, we've shown that perfectly.
And have you, maybe this was a little bit old school, but in the early days of InsurTech 2000, at the time when there was still a discussion about whether it's InStech or InsurTech, right? 2015. What an important, discourse.
Absolutely.
Have you found pushback, or how have you convinced some of the kind of corporate sponsors potentially who said, if we want to use it, we want to use it exclusively because we want to get an edge in the market, because that tends to be how corporates think. That's in a way that makes sense if they are somewhat indifferent about the performance of the company, or whether the company's service is not one that requires multiple other customers or data plays to even work, right? Have you had such arguments internally, and how were you able to resolve those?
Yeah, absolutely. And I'm sort of casting my mind back to some of my previous roles here, because thankfully QBE has shown a remarkably mature attitude to this. But you're quite right that organizations tend to get quite grabby about the things that they see value in and want others not to have that. I think the dialogue has moved on though, and it's more now about data and access to data, even more specifically for model training and machine intelligence, that organizations are starting to get a bit finicky about. And what I mean about that is that when you start to consider an organization's perspective about what they're giving up to allow a machine learning model to be trained on their data, that's a decision that you can only make once. Because once it's gone, once the parameters are tuned in the model, that's a benefit that another organization's got that they can take elsewhere. And depending on the license agreement you have, that can then potentially be sold as a capability to your competitors. This is actually something that I like about the recent approach to ventures investment in insurance, in that I think the inclination for companies to allow that to take place increases when there's an upside financial advantage to them as well.
Yep.
Namely, that they own a stake in the company. Yes, you might have a model that's sold to your competitors, but you benefit from that too. So I found that discussion gets substantially easier when you start to look at that upside advantage too. And that's really where the dialogue is moving in our space. In why would we, why wouldn't we? More often than not, we're siding on the why would we side, particularly because people understand that a well-trained model and computer vision for property analytics or for text analytics can be worth an absolute fortune, and there's a lot to gain from it.
I think that's a very interesting point to say that if you, within your enterprise innovation, within your partnership, you also have the capabilities to invest and gain some form of equity upside, you can make some discussions where it's otherwise really hard to commercialize certain restrictions on something, and then it doesn't happen. You can kind of unfold that somewhat, and then to say, well, at least if we commercialize it a lot, we'll still have an equity upside about this as well. I see that point. I mean, we even see that not just on enabling technologies, but it's something we see a lot in embedded insurance, when you have really large, basically anytime there is a significant investment. Now, whether that investment has already been done and you have these assets that you now share, or whether it is a future investment, it has traditionally been quite sensible to have an equity upside. And I feel that is one of the advantages of venture proliferation.
It's the nature of partnerships in the end. When everybody stands to benefit, there's a lot more value in the partnership itself. And I'm a big proponent for making sure that everybody does have upside advantage. That the risk is shared more generally, but when it's a financial discussion as well as a partnership discussion, more often than not, things tend to go quite well. But the one exception to that, I would say, is that joint ventures are often quite challenging. When you draw down the line in voting rights, for example, it's very difficult to get consensus. We often take board seats in the companies we invest in. That means that those companies can benefit from the insights that our team might have collectively, whether it be in investment and finance or in technology or other areas. But we don't dictate. We don't tell our portfolio companies what they should do, just what they could do. And from the growth that many of them have seen, I think it's obvious that model works quite well. And many of our co-investors follow a very similar model as well. And that's why it's so important in the ventures community specifically that we all talk to each other. We all know each other, and making sure that we trust each other, we can look at each other across a board table. It's a big part of the success of the companies that we collectively nurture and mature.
But how just to ask an additional question, how do you solve this? Do you have, let's say if you invest in a company, for instance, minority stake, and you have a lot of, let's say, interaction and sensitive strategic stuff, and then the company is sold to somebody else, you have a problem. So do you always have then, let's say, special rights, or do you always acquire, let's say, the majority, or how do you solve this?
It is a challenging question. And obviously that's why we tend to create a very good relationship with our corporate risk and legal teams to make sure that we're protected in that way. And most of the time we do take a minority stake in these companies. We can obviously vote with our shares, but that doesn't prevent it being sold to a competitor and being acquired there. What it means is that you need to go in with your eyes open. The nature of the data that you share or you collectively work on with them is either protected by commercial agreements. For example, if we become a customer of one of these organizations, they can't take in data from a commercial arrangement and then sell it to a competitor. That still has to be ring fenced and secured like they would with any customer's data. Or for data that we would be happy to become a corporate asset of the organization is appropriately anonymized or secured in some other way to make sure that they can still retain the benefit from it, but it wouldn't expose our organization in a way that we wouldn't be happy with if it did end up in a competitor's hands. But it is a delicate balancing act. It's one of the reasons that I've come to greatly respect our teams in legal. It's because it's their job ultimately to make sure that we're protected from things that we don't anticipate.
What I find always interesting from these discussions, and I remember we have a few corporate partners who we work very closely with, and at times I speak a lot more with them than with my own team, and we're trying to get things done. And what I always then and then someone asked me, one of the board members said, "Listen, aren't we getting too dependent on you if we did this?" And I said, well, like any good marriage, it hopefully hurts when you break up. Otherwise, why have the marriage in the first place? And I think it's interesting how there seems to be this finite mindset about it's this one thing that we want to control, rather than the how many ideas did all the three of us had over the last 10 years, and how many played out and how many didn't, and how many did we know in advance, and what's going to happen in the next 10 years. So I always, everything is in flux rather than this one thing to capture. And equally, whether you are paid a salary or some form of service fee, imagine you had that same mindset with your employees or your colleagues. Keep them stupid because they could be poached by a competitor, and it turns out they are very few. And
so aiming for that. Ultimately, if your staff are getting poached, it means you're hiring the right people.
Right, and I think it's with that in mind, and but I feel it's still, and in a way I get it. I also think it is something about being a certain, director, and you need to kind of, there's certain legal elements about it afterwards. There's certain politics involved, but at the end of the day, there's just, I believe, a lot more to gain in general than always trying to fend off. And again, I believe that has been the proliferation of venture thinking into partnerships rather than the traditional corporate, not invented here, internal innovation or kind of M&A, I'll buy you and I'll buy you cheap, I think has been one of the positive developments over the last couple of years. And I think our industry will benefit from it tremendously.
Oh, I absolutely agree. And look, there's a lot to say for the model of ventures investment. I mean, obviously it delivers capital to companies that need it to realize their vision, but it also exposes, more traditional, more incumbent organizations, like QBE, to the possibilities of what might be, of what you can do if you set your mind to it. And the classic example of that is the timeline for implementation of things. I love going to our internal teams and saying, in the last 6 weeks where we've made a slide deck, this company we've invested in has created an entirely new product and brought it to market. And that's a great exemplar of the challenges that organizations like ours have as regulated entities, but also the opportunity to look over the fence and to learn, completely learn from what we might be able to do if we only don't get in our own way. And look, I think everybody benefits from that equation, as long as you realize that there are specialist skills that we can't hire for and that we have to go outside for. And that's another way of saying that if we went to a startup and hired all of their staff and tried to replicate it internally, we'd fail. And that's why we don't do that.
Before going on to a few other topics, let's say you had to leave the great job that you have, and you had to go to another insurer, and they were asking, listen, Alex, we want to replicate something. We want to, which conditions would you present to say, listen, guys, only under these conditions will I consider building a similar or even better X organization, and things like who should be the board member, what should be your freedom, which function should you have, how long should their financial community, if you could really, because I think there are, I think that would help some other organizations to kind of think about this a little bit. Could you share your 2 cents on that?
Absolutely. Look, there's a couple of not negotiables, and one of those we've already briefly touched on, but I'll expand on it. And that's the direct access to the decision makers in the organization that give you the permission to do what you're doing. And mostly that's the board, it's your group executive. The archetype of an innovation or ventures function that does not work is a team that's challenged with doing big things, that's shoved off to the side, out of the way, and can't demonstrate the traction they've got or even have the permission to do those things because they're not considered to be relevant. So, the one thing that works extremely well at QBE Ventures, and we're very glad to have their support, is that we'll have board members call us up and have conversations about what we've seen or something that they've seen that they want to know more about and want to know what we're doing in that space. And that kind of interaction is essential.
So, Alex, does that mean, let's say you're probably assigned to some group board or someone in charge of that, but what that means is you can call up other board members, you can go, if you are looking into renewables, you can look up in whichever business unit is really cutting edge in renewables underwriting, and you just call them up. You don't have to ask permission. You'll inform people about, but that's ultimately what you're saying, right? You want to be able to. Okay.
Absolutely. And that's an essential part of what we do. I mean, I'm going to throw people of my own ilk under the bus here, but technologists I've found are particularly poor at doing this. We don't make friends easily, and that's probably due to the nature of who we are. One thing that I've had to force myself to do over the last 15 years is to become not just extremely friendly, but to listen very well, to the point where, I know 90% of the people in the organization, and I can pick up the phone, as can my colleagues, at any level in our team. And, we always say, this is our slogan in QBE Ventures, we're a zero ego team. Anybody from our associates to our analysts to, the partners in our team, like myself, like Lynn, like Dan, can pick up the phone and anybody in the organization will answer. They invite us to their team sessions. I just got off a call presenting to one of our claims analytics functions in Australia, presenting on large language models, because everybody's interested in that space right now. And the fact that we're invited to those forums, that they welcome us with open arms, shows that it's not just us yelling into the void. We've made ourselves a part of the organization, but that is a two-way street. It's essential that if we need to speak to someone, or we want to show someone a benefit that they can have, or we need to discuss something with a board member or a group executive member, that we can do that. And without that in place, it's extraordinarily difficult to do what we do, if not impossible. And the other side to that comes down to regulatory risk and exposure. A lot of organizations love to talk about the innovation team that they have, and the opportunity they have to create and to experiment and to rapidly fail. All of these things are wonderful ambitions. The thing that often gets in the way in highly regulated organizations is when somebody says, yes, you can, but. And the but on the other side of that is often, we've got this complex data policy or a legal policy related to the use of information or systems, or you've got to go through this intensely complex process related to security. And all of those are good things. Don't get me wrong. They ultimately protect us from the mistakes we might make. But creating an environment where there's balance between the behemoth procurements you might make of it, a policy system that's running a multi-billion-dollar portfolio, or something that you're experimenting with to see if it gets traction that's very early in its days, using the same process for those things makes you doomed to failure. Creating right-sized processes and teams willing to help for younger, innovative capabilities, particularly when you interact with a portfolio in ventures investment, is essential to making sure that you can succeed in the space. And I've spent enough time in risk reviews and legal reviews in secure by design assessments to know what good looks like and to know what bad looks like quite early on.
And so I remember those things. It was someone would say, if we basically managing a single customer data point is the same as managing 2 million, which obviously is not the case in terms of risk exposure. And so I guess to come with a sheet, this is how we want to have a certain sandbox, which is limited to the amount of data, amount of policies. And exactly. At the end of the day, we want whoever is the board member to say, and if I keep these parameters, and their experience is so helpful, right? If we maintain these parameters, I want to get a board approval that we can try. Because otherwise it's not going to get there because the butt is too heavy. Is that
exactly that? And that's surprisingly exactly what we've called our capability. So we've built a system that we've nominally called Sandbox alongside our partners in security and legal and procurement. It's designed as a fast track to experimentation. And I'm pleased to say that, the design for that system was done in partnership with all of the people that protect all of the other QBE systems that are adventurous enough, that have come on the journey far enough, that they've been sold the vision of what we're trying to do. So that sandbox is every bit as secure as the rest of our systems, but it also means that now we can start a new data partnership in weeks, not months.
Okay.
And a lot of months as it was previously.
So you have not just a policy sandbox or procedures, you have a technical sandbox, right?
Exactly.
Understood.
And
any other non-negotiables?
Look, I think that's largely it. I mean, the permission to fail is always important, and a lot of organizations will pay lip service to the permission to fail. The one thing that's very obvious in ventures investment is that when you invest in younger companies, some of them will fail. On balance, you do want to make a positive return, but if an organization looks at a company that packs up shop and goes away because they've realized they can't succeed, and defines the success of a ventures team off the back of that, then ultimately, you're not really set out for ventures investment in the first place. And, we're seeing a very interesting time in market right now. Economic conditions are obviously quite interesting. Interest rates are up. That means that there's a lot of younger companies that are pressured for capital. There's a lot of struggle to raise. It also means there's a lot of very high quality companies out there that are actually going quite cheaply. And it's a good time for ventures investment. The archetype of a company with a corporate venture capital unit that isn't set out for this, that doesn't have the right appetite, is that their willingness to invest now will dry up. that, they won't want to invest because they're nervous about the success of those companies, even though ostensibly they're very well valued, particularly because, tough economic conditions makes people, get generally nervous about the deployment of capital. Look, I'm pleased to say that QBE is still very much engaged in that way. And, we're still continuing to invest, and we will continue to. But a big part of that isn't just because of the financial return. It's because the value of ventures investment executed well in a corporate context is the benefit you get to the organization by having those companies there at all, almost to the point where the financial return becomes less relevant. And, if you talk to people in QBE today, they'll tell you that the opportunity to work alongside or with or build on top of the technologies that our portfolio delivered to them, that's what they'll think of first, even in our CFO team, above and beyond that financial return, which, thankfully is also quite strong. But, I'm very much keen on having a balance between the two there.
I would like to ask an additional question, because you also have a background, let's say, in tech companies. If I compare, let's say, the way, tech companies acquire startups or scale-ups, it's totally different from the financial sector. So, and I just wanted to know your opinion on that. Let's say if you have to, for instance, Google or Facebook, they always go for bold bets, but they're also willing, let's say, to acquire YouTube, and everybody says, oh, that's much too expensive. And then a couple of years later, it turns out to be an excellent investment. Or
Zucker started on Yahoo and Google.
But you can take a lot of those examples. And in the financial sector, let's say you want to invest, but you don't really want to acquire, you don't want to pay a high price. In the past, all those, let's say, financial companies said, okay, now the valuation is too high, now the valuation is much lower, but I don't see an enormous amount of extra investments, because, let's say, the big corporates are watching their own share price, etc. So what's your opinion about this?
Yeah. Look, don't get me wrong, valuation is still very important. I mean, we have a place to play in our investments, and we won't throw silly money into the market. It's good to see, particularly in these economic conditions, that we're starting to see a lot of organizations that had, let's call them inflated valuations over the last 5 years, start to realize that things are fundamentally different now. And I think the whole crypto boom showed that quite strongly, that sometimes valuations got obscene, and that was problematic. Having said that, I think it's important to recognize, like I've been saying, for this entire discussion, that often the balance needs to come into where you're seeing value outside of purely financial terms. And if you look at the common archetype of where a technology company invests, sometimes that can actually be a punitive acquisition. That is, you want to remove a product from market because it competes with what you do. So, you buy it to kill it. Sometimes it's buying something because you see an opportunity in market, someone that's done something incredible, and YouTube is the classic example. I mean, Google itself before that was the example when Yahoo had the opportunity to buy them, which I'm sure they've kicked themselves for the last 15 years. But when you start to see that someone has created something that you couldn't build for yourself, that you haven't, and it's scaled and you've got an opportunity, it's very hard to project to where that might go, to think that, it looks expensive now, it could be worth 10 or 100 or 1,000 times more than that tomorrow. I mean, nobody has a crystal ball, but that's where value investing comes in. If you truly believe in the vision of what a company's doing, if you see general applicability in the market they offer their product, then, you can quite easily understand where it could scale to. And insurance is the classic example of this, where, going back to what I was saying before, if we can imagine ourselves as a customer of one of these organizations, because you can see the size of the property insurance market globally, or the liability market, you can see that because you can understand the value that might offer to the market, we can go and have those discussions with the people that we know at our competitors and say, we're not telling you what to do, but we've played with this and you should really have a look at it as well. In full disclosure, we own a part of it. Often those discussions go very well. And when you start to see this traction being had from one of these younger companies that has, frankly, utter geniuses create something incredible, and TensorFlight is a great example of this. They were the only company in the world that was doing oblique imagery analytics of commercial buildings, looking at street view style pictures and pulling apart the underwriting factors you needed to price for them. We looked at the market and nobody else could do that. I shouted from the rooftops after our investment. I mean, look at this, guys. This is something that's incredible. It's different to what's being done now. And their customer base today speaks for itself. It's a broad swathe across the entire industry, and they've scaled tremendously, even though at the time they looked quite pricey.
But wouldn't it be a great, let's say, time for, let's say, those big corporates, let's say, to acquire, let's say, in your portfolio, especially those startups which are doing pretty well because valuations went down?
It is a good time to invest. Absolutely. I mean, and look, this is the nice thing about the insurance industry in general. People often describe it as recession proof. That means that almost uniquely in the market, we've, as an industry, we've got capital to deploy. And, where valuations have got a bit soft, it's a great time to snap up, not bargains, but companies that are being more realistic about their value. So, and from what I'm seeing already in the market, you are seeing some significant investments and acquisitions by incumbent players in insurance because the timing is perfect.
Okay.
And shifting gears a little bit, and Alex, it's super interesting. I was just conscious about there's a few other topics. Let's see that we can at least vaguely touch them. I recently had a conversation with a colleague about how to attract talent, right? And I won't go into all the different aspects, but I think doing cool shit is basically what I've come down to. Having some cool things to do. For some, it is also linked to purpose, but doing something that you find interesting. Do you see that, for example, having not just for your own team, but potentially by association towards others in the organization, that having this type of lighthouse and kind of cool topics helps to bring people on board and say, listen, if you have a really cool idea, we have this team, you can pitch it there, and there's a higher probability of getting it done rather than, just working with your Windows 95 tools because, they've been kind of written off. Have you seen that, or have you seen that feedback within the organization?
Yeah, absolutely. And, maybe to answer that question in a longer way, I remember colleagues in the technology industry that when I said I was joining the insurance industry, asked me why I would even consider doing that. The insurance industry is boring, it's slow to move, nothing ever happens there. My experience completely openly has been the exact opposite of that. The one thing about the technology sector is that everybody is sure of their own capability and skill. It's very high ego. People compete with each other. They fall over themselves to demonstrate why they're better than somebody else, why their capability that they built is better than somebody else's. Insurance, in my experience, has been very willing to learn. Yes, there's pockets of conservatism. Yes, it can be quite politically challenging sometimes in an organization. But to your point directly, often when teams are given permission to go somewhere and share the exciting thing that they've thought of, or even better, when they bring an exciting thing to a team like mine and we say, yes, we can already do that, or we're about to do that, and here is a company that you can speak to and co-develop that idea to create something fantastic. The way that their eyes light up when they realize that they can do that there's a capability that lets them do that, that's world changing for these people. And look, I mean, I hate to use these motherhood statements that make it feel like, we're God's gift to the insurance industry, but we spend every day that we have helping this industry to achieve things that sometimes we get in the way of achieving for ourselves, purely because we're seeking to serve our customers. Sometimes through capabilities like ventures, we have to serve ourselves and the companies we invest in.
Which
that would be the strongest argument that I have for joining a sector like the insurance industry, and particularly in an innovation or ventures role. There are millions of people globally that want to learn but can't, that are only just being given the opportunity to join the 21st century. And I don't say that lightly. I know that many people have experienced the age of the systems in insurance. Some of them still haven't joined the 21st century.
And would you say, do you have like a select list of topics that excite you or others where you kind of think that resonate particularly well? Because my hypothesis is, let's say, getting someone off a mainframe in an 8-year project might not quite be that. It wouldn't excite me. I would stay away from that.
Well, absolutely. And it's a fair call, right? And we do a lot of that kind of migration. You know, there's many teams, and I have the greatest respect for people that can sit down
Absolutely.
for 8 years and replace a mainframe. The thing that I'm seeing a lot of now is that skills that have been built through sheer persistence in the technology sector are being applied to insurance, and it's world changing. I mean, machine learning is a key example of this. There's a tremendous amount of talent globally in data set preparation, data science, data analytics, all of the things that we need to transform an industry. The one thing that data scientists and machine learning engineers love is when you say, you want data, I've got 200 years of property exposure data sets just sitting there waiting for someone like you to pick them up and create an exciting new product. That opportunity to apply a skill set to information that's just sitting there statically, machine learning engineers' eyes light up. Even the less exciting things, core system replacements, when you bring fast, agile teams in from like embedded insurance providers and say, yes, it's going to take 8 years to replace our core mainframe, but to inform where we might go when we replace that mainframe, let's start a 6-month project to drop a system into place and see if there's a market for embedded insurance, or there's a market for a new type of partnership, or pre-filling and underwriting. There's a lot more appetite now in incumbent insurers to see what they might do, a scouting party, if you will, before they make some of these really expensive, large decisions to replace core systems. And QBE is no different to that. We've got pockets of capability we've developed to try things that are coming that will be got to once the mainframes go, purely because we like to understand the ramifications of our decision through early experimentation before we have to spend the big bucks to make those things happen.
How about net zero? And I mean, you've mentioned it a little bit, geospatial, IPCC impact. Because I'm always looking about, where can we move the needle somewhat as an industry within the net zero paradigm. What have you seen? What exciting things could you share with the audience? And what are you still hoping for? Where are our expectations not yet met?
Yeah, and it's obviously an extremely important area. Look, I mean, QBE is a proud member of the Net Zero Insurance Alliance, as are many of our competitors. And the reason that we are is that we believe in the vision of what's being achieved there. The really interesting areas that we're starting to see emerge are sustainable energy, particularly. And if you look at the classic example of the struggles in sustainable energy, it's that these things are new. They work in ways that are difficult to underwrite and to price because of their newness. What we're starting to see is newer insurtechs start to provide pricing books, to provide understanding for how we can underwrite wind projects, particularly offshore wind or solar panel farms, and look at exposure. And geospatial is a key example of that. Where should I put my wind farm? Not just because of where the wind blows, but because of where the waves aren't going to break them. Where should I put my solar panels so that hail doesn't destroy them? What can I do to construct a home or a business that's resilient to the types of natural disasters that affect that area? These are examples of things that are happening today. And, I really do think the insurance industry is starting to shift from pure risk transfer to what we're calling resilience. And if you look at the QBE annual report, you'll see 52 mentions of the word resilience. And we're really keen on this topic. It's working with our customers in an extension of classical risk services to make sure that our customers understand why their risks are the way that they are, and to work with them to mitigate or to reduce those. We're seeing a lot of new talent enter the insurance industry, particularly to work on that. And it's coming from areas that you might not traditionally expect. And there's a company I was speaking to the other day that was almost entirely staffed by ex-police, general law enforcement, and ex-special operations military people that focus on safely moving cargo between ports. Now, technically, they're an insurance capability, but not the traditional background of person that would participate in our industry. We're starting to see this transition of people that have built skills in many different sectors, and ESG and net zero are a classic example of that, to things the insurance industry can benefit on, not just in our traditional products, but because of where we're moving towards. And that's that, gripping the challenges we collectively have by the horns, looking at what the IPCC is saying and making sure that we and our customers are prepared for that world.
I've been recently also looking at some kind of green products, right? And some example of what you've mentioned is apparently, at least on German buildings data, if you have highly energy efficient houses, claims and can generate them digitally, you might have an underwriting edge as well, or just kind of like a benefit. So I thought that was quite handy. Still takes ages to get insurers to kind of go, because as you've said, even if you now the product team wants it, they don't have the mandate, or they don't have the IT resources, or you cannot easily change how the buildings pricing and rating engines are structured. So I think that kind of goes back to the ability to have some form of sandbox environment.
We've seen a really interesting trend in that space, and I think it applies generally across all insurance products. And that's that the more engaged a customer is with the nature of their own risk and exposure, the better risk they tend to be.
Yes.
And I mean, that was the core proposition behind a joint venture that we did with Safety Culture called MITI in Australia. We noticed statistically that those customers that are told about their risk insights and act as a result are the ones that we want to retain. They're the customers that actually make themselves resilient and rely on insurance as a fallback. That is the direction that all insurance products are heading. And that applies equally to homes and customers that look after their homes, or when you tell them about a blocked gutter or a broken tile, they do something about it. They're the customers that represent the archetype of the future of our industry.
I think it's interesting that you mention it. We've gotten the same feedback around fleet insurance, and it was about fleet telematics and about all the cool things you can do, and how gas prices. And then one he was in charge of underwriting globally. He said, listen, at the end of the day, the management needs to be for safety. That's it. And if you go there, you'll see it, you'll feel it, because if no telematics, etc. If all is, people are rushed and it doesn't matter, and no one cares about safety. But if you care about your own risk, that is the best thing you can do. And then I get that. And you would argue that someone who has invested a lot in their house and made them energy efficient might look at the opposite of don't be gentle, it's a rental, right? That's ultimately the premise. You want to have some investment and some care for your property. This was the same reason my dad did a pretty good run on insuring classic cars, because it wasn't cars, it was art on wheels. And you kind of have these things. Understood.
I love it. It's the opposite of be careful, it's my castle. I love it.
Yeah, no, exactly. But I think it's an interesting, and that's why I love these conversations. It's kind of when you hear them, it's like, oh, it's common sense. But I haven't quite heard someone phrase it like that in such a I think generally applicable statement.
It's fascinating. And one of the recent entrants I've seen to the insurance industry is behavioral scientists, and looking at customer behavior and response to risk is an emerging field. But 10 years ago, you wouldn't have seen behavioral scientists in an insurer. Now you do. So read into that what you will. The number of underwriters that are good at their jobs because they know their space back to front. They can't explain what a good risk looks like, but they can point at it.
Yeah. So conscious of time, Alex, is there a particular topic or spin that we weren't able to touch on that you would like to kind of float before we wrap up?
Yeah, just one. And it's more food for thought than anything else. So there's a lot of people that will tell you that the insurance industry is under greater threat or challenge than it was historically. I think that the emergence of new risks and new ways to assess those risks, to underwrite them, is actually an opportunity. Now, and yes, things like cyber risk are very challenging. Understanding what catastrophe and a bunch of different products looks like is very challenging. But the one thing I'll say is that the insurance industry has been around for a very long time. The reason that it is because it's something that creates the society that we have today. It gives us permission to take measured risks, to operate the companies that are essential to our modern society. Now, I'm very excited about the future of the insurtech sector because it delivers the incumbents an approach to deal with that future, no matter what that future might be.
And I think that's a very good point. I think mentioning to the 50 mentions of resilience versus risk transfer kind of goes into that. And then we close I believe the first fire brigade, if I got my history right, was by some insurance company.
It was absolutely fire marks on the side of buildings to record who you're a member of. That was the world that we formed.
Right. So I think taking a step back from your product and sometimes looking at the problem and saying, do I have the capabilities and the interest of solving this in a slightly different, adjacent way, it's better than innovation theater.
Absolutely.
But I'm still.
I don't think any of us would do what we did if it was just theater.
But yeah. I'm still more skeptical. So if you compare insurtech and fintech, then you see, for instance, that if you take Apple Pay and Google Pay, and this understanding of data and also the customer journey, etc., I think the insurtech is, let's say, 5 or 10 years behind. And,
I think you're right.
And I'm not so sure if, let's say, companies like Palantir or this kind of totally focused data companies, in the end, because they just have better data and understand data, would be much better in pricing, for instance, risk, and then also putting insure products just into the market. Yeah. And if they have a better understanding of the data, then they also would have a competitive advantage in their pricing and competing. So I still don't really see that those incumbents are so much focused on those big data startups. If I would be an incumbent, I would acquire, let's say, one of the best, and try to really speed up. To put the data,
and it's been tried.
To put the data in the center of the operations.
It can be a great way to kill a very promising company, though. There's nothing worse sometimes than destroying the culture of a young company by a large company buying it entirely, and that's always something you have to watch out for, particularly with M&A.
And I would argue, right, Tom, if I take a step back from insurtech, I think a couple of observations have been done. One, these alleged new underwriting models have not delivered. I think there's some pockets, but in general, the actuarial claims-based models have been better at whatever Lemonade said their flywheel was. Just in terms of their loss performance. And then the second thing, what you see, and I think there is the agent, the existing distribution, relationships, and I would paraphrase it with trust. So anyone who works in commercial brokerage know that just because actuary or underwriter says X doesn't mean that the market accepts that. And so I think what is really, really hard to build, and it's not just a technology and being smarter and being right, it has to be earned over time, is trust. And that insurance companies and their respective networks of advisors, etc., have in spades. So I would argue that would be something, if Apple has the trust as a brand of the customer, that to me is more dangerous than someone having better data and kind of coming purely from the capabilities point of view, because distribution is really, really, really hard in insurance.
Yes. Yes.
And so I would counter that a little bit.
No, I completely agree with that. And, to your point, doing something net new is often a great way to guarantee failure in insurance. Building on and extending with the incumbents is often the source of success. And, if you look at the most successful insurtechs in market today, they've offered some essential service that adds something new to an existing product or creates an opportunity for a new product in the existing context. They don't just try and throw the entire industry in the bin and do it themselves. And, again, Lemonade is a perfect example of what not to do, unfortunately.
But interesting times.
Very much.
Alex, it has been a true pleasure. Thank you so much for letting us pick your brain. Tom, thanks again for being a voice of caution and not overexcitement that I always lean towards, like, yay, pick the right industry, go insurtech. Been a pleasure as usual. And I wish, Tom, I wish you a great a day, and Alex, you too, but hopefully a little bit shorter than ours.
Okay.
Absolutely. Thanks so much. It's been a pleasure.
Yeah.
Thank you very much. Take care.
Thank you
Bye.
very much.